Congratulations, you're ready to access the cash value in your life insurance policy. And you want to keep your finances separate, your family finances separate from your policy finances. Today, we're going to go over everything you need to know about setting up a segregated account for your policy finances. So stick around to the end. Hi, I'm Olivia Kirk.
And I'm Tim Yurek. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel and don't forget to hit that bell to be notified when we upload new videos. So, step number 1 is to set up a segregated, separate checking account, separate from your family finances. Now, with this segregated account, you have two options. You could do it set it up at your regular bank, which has the benefit of quick and easy transfers, usually within a day or two, between bank accounts. The second option is to go online and find a new bank that may pay a higher interest rate, but may take a few extra days for transfers between the bank accounts. So keep that in mind. Now that you have the new bank account set up, the second step is to request a policy loan. So however you do that with your insurance company, get the policy loan and deposit it into the segregated checking account. And from there, you'll pay your major expense, whether it's paying off a credit card, buying a new car, paying for a wedding, going on vacation. You'll pay right from that segregated checking account. Now, here's the key, is to pay yourself back. Just as if you took a loan from the bank, you're going to want to pay yourself back. So you'll set up an amortization schedule. A lot of times our clients will either determine a monthly amount that they could afford to pay back to the policy loan, or they'll say, hey, I want to pay this back over 2 years or 5 years, and that will determine the payment that they make back to themselves.
Keep in mind that the deductions to pay back the policy loan will come directly from that segregated account.
Right, so you'll have to transfer money from your family checking account into the segregated account back to the insurance company.
The next thing to consider is whether or not to pay yourself back at a higher interest rate than what the insurance company is going to charge you. And keep in mind that if you charge a higher interest rate than the insurance company is requesting, the loan will be paid off quicker than the amortization schedule. So what that means is you may have a 36-month amortization schedule, but the policy loan will be paid back in 34 months. And if that's the case, we always recommend stay on the schedule by transferring money, that monthly payment, from your family finances account to your segregated account. And that money that stays in there is literally the profit that you made from yourself for doing self-finance. And that once those profits build up, then you can use it to make paid up addition rider payments or buy additional policies. So in his best-selling book, Becoming Your Own Banker, Nelson Nash made a great argument for paying a higher interest rate. He called it "Don't steal the peas." And he related it to, if you owned a grocery store, your first inclination is to want to buy groceries or go grocery shopping in your store and go out the back door, bypass the cash register. Well, if you do that, he referred to that action as stealing the peas. And what he meant was you have to pay back the principal and interest. But if you have to shop at your grocery store, I mean, let's face it, if you owned a grocery store, you wouldn't want your wife caught shopping at ShopRite or Price Chopper. So you're a captive customer. You have to shop at your store. So then you should pay yourself a higher interest rate. And that's what he meant by not stealing the peas. Pay yourself not only the interest rate the insurance company is requesting, but a higher interest rate because you're a captive customer.
And think about the benefits of this. Every time you make a payment back to your policy, you're increasing the amount of capital that's available to you, not to the credit cards, not to the finance companies. You have access to every dollar you're paying back to your policy loan. Now keep in mind, setting up this segregated or separate bank account is a completely optional step. You do have the choice to put the policy loan proceeds directly into your family bank account, but there are some benefits to doing it this way with the segregated bank account.
First and foremost, it just makes things easier to track. So you can track your progress, you can witness or realize at the end of the month your profits from self-finance.
So instead of the bank or finance company or credit card company earning those interests every month, you'll be able to see how much they would be earning off of you. Now, let's recap the 4 steps to getting this set up for yourself. Step number 1 is to pick a bank and set up a segregated checking account there. Number 2 is to request your policy loan and have it deposited directly into your segregated account. Number 3 is to create an amortization schedule based on your cash flow or your timeline. And step number 4 is to track your progress by reviewing your bank statements every month. If you have any questions on this process, please be sure to visit our website at tier1capital.com to schedule your free strategy session today. It's our mission to help as many families as possible to make the best financial decisions possible. And this is one of the value adds that we offer to all of our clients. So be sure to check out our website today. Also, if you like this video, please be sure to give it a thumbs up and don't forget to subscribe. It really helps the channel.
Thank you so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters.